1997, yeah. So she holds a PhD in accounting and finance from Alliance Manchester Business School, the University of Manchester. Her ongoing research work have appeared in research journals of financial and accounting. Main research interests would be market-based research, disclosure and regulation, corporate governance, and capital market. She is currently one of the assistant editor for Journal of Islamic Marketing, JIMA, and also serve as a guest reviewer in Asian Journal of Business and Accounting, AGBA, and also the Journal of Emerging Economies and Islamic Research, JEEIR. On top of that, she's also one of the main committee setting up the financial lab at the Faculty of Business Management here in UiTM, and is very actively engaged with the industry. So Dr. Balkis' research interest area would cover market-based research, disclosure, regulation, Islamic capital marketing. So today we're very lucky to have Dr. Balkis with us today to talk about financial management, manage the need, and raising capital. Dr. Balkis, the screen is yours. The floor is yours.
All right. Can you hear me? Can you hear me clearly?
Boleh dengar.
Right. Assalamualaikum warahmatullahi wabarakatuh. I'm Balkis Haris from Faculty of Business and Management. I did not hold PhD in accounting, but my PhD is actually in finance, but they call it a PhD in accounting and finance. But my major is finance. So basically, I don't have any accounting or the pure accounting background, but I have a finance background. I'm from finance background. Okay, I'm going to share my screen with everyone. My topic today is about financial management, raising capital and management needs. All right, I'm sharing my screen. Hold on, yeah, I'm sharing my screen. Can you see my screen? Not yet. Hello? Can you see my screen?
Belum lagi.
Nampak dah?
Nampak?
Maybe my internet is a bit slow.
Nampak? This is balance sheet. Yeah, and then this is income statement. I'm going to share this one afterwards. And this is Apple. I'm going to share this one as well. All right. So, okay. Share content. Screen. All right, I'm sharing my screen. Can you see my screen? Hello? Hello?
Nampak pun?
The first? Nampak
Nampak.
Okay, nampak. All right. So, let me check how to make the screen bigger. Okay, under financial management, raising capital and management needs. So what we need to know about the financial management. Financial management is, as you know, every company need to know about their business finances. So basically, business finances is like an air for us to breathe. Yeah, macam every day we need air to breathe. So company or businesses also needs to know their business finances as a need for cash flow to stay in the business. So it's compulsory for each of the business owner to know about their finances. And the financial management is actually to show the financial health of the company. So basically, whether the company is a good company or a bad company, everything will be known from their financial management, which is from their balance sheet, income statement, and cash flow. So for example, the balance sheet will show the company asset, liabilities, and equity. Income statement show the company sales, and the end is the net profit. The cash flow will show about the money in and where it spent. So if let's say we wanted to start a business, every business owner needs to understand their finances, and they need to understand their financial statement. So the financial health of the company will show in the financial statement, where it will in the financial statement, it will show in the balance sheet, income statement, and the cash flow. So the first key concept of financial management, the first key concept is the cash flow. Di sini kita tengok ya. The financial management, when we wanted to start the business, we need to know the cash flow. We need to know the cash flow. We need to know where the money comes in and how it's spent. So for this cash flow, hello? Hello?
Ya, Doktor.
Oh, I tak dengar di belah sana lah. Hold on ya. Can you see me or you see my slide? I'm so sorry.
We can
you
see your
me?
slide.
Can you see me?
We cannot see you, but we see your slide.
Oh, okay. I think because of the might be because of I'm using an iPad, so iPad cannot show my face. It only show my slide. So okay, cash flow. The cash flow will show where the money comes in and how it is spent. So we have to make sure that the collections and the payment is on time, which will help us to stay on track, and also for the emergency. So for this one, I nak tulis, yeah, I wanted to write here, draw, okay. The cash flow here, the cash flow is important because it will show how much cash we have, and it can be used for emergency. For example, if we run a seasonal business, for example, like a landscape company, where the cash and the flow can only happen in a few short months. So we need to plan for costs such as for rent, utilities, when the business sales is slowed down. So here, yeah, dalam cash flow, it shows money comes in and how it is spent. So the next one is the startup cost. So if we wanted to start a business, we need to know how much is the capital, the first time capital that we need to come out with. So there are a few costs that there are a few expenses that we need to identify. One is on-time expenses. Second is ongoing expenses. and then the expenses on the investment in the asset. So for the one-time expenses, such as for the one-time expenses, for example, permits, the license, registration fees, logo design, business cards, website, what else? Down payment on rental property, and also leasehold improvement. Those are all the one-time expenses. A second one is the ongoing expenses. The ongoing expenses such as the rent, payroll, wages, for the employees, taxes, accounting services, insurance, utilities. Those are under ongoing expenses. And the third one, when we wanted to set up a company, we need to do an investment. We need to buy an asset, furniture. Yes, for example, sometimes we need to buy furniture, inventory, equipment, vehicles. So those will be accumulated under startup costs. So finding all these three costs will allow us to know how much money we need to have, or how much money that we need to personally invest, and where to get the money from, or where to get the finances from. Is it from a personal loan? Is it from business loan? Or is it from other type of financing? And this startup cost is important because later we need to recover it back from our businesses. The third one, when we wanted to set up the company, let's say we already know what the product we wanted to have, we need to identify the break-even point. Under the break-even point, we need to start recovering the cost, where the cost paying all expenses and generating profit from the business. We also need to know how many products that we must sell and how much price that we need to sell, and what is the pricing or the selling price. So for the break even, we need to know the fixed costs, what are the fixed costs, what are the variable costs, and the selling price. So the formula, this is the formula for the break even. The break even is all the revenue sufficient to cover the cost. So to calculate the break even point, we need to know the fixed costs. What are the fixed costs? Fixed costs include rent, taxes, salary, and any other monthly expenses that do not change. So fixed costs are the costs that do not change, whether we sell one or more product. So it's a fixed cost. Variable costs are the costs that change according to the number of sales. The variable costs, for example, raw material, factory labor, and sale commission, because sale commission are based on the number of unit that we sell. So and then we need to identify what will be the selling price or price per unit. We can actually adjust price per unit if we wanted to have only break even, or if we wanted to adjust for the profit. So if we want higher profit, we'll adjust for the price per unit. So sometimes it depends on the season. Price per unit, sometimes we have a discount, and sometimes we don't. So we can adjust the selling price up or down, and then we calculate the break even. Right. So for example, break even equals to, let's say fixed cost is 80,000, and price per unit is 18, and times price per unit. Selling price is 68. So how many units that we need to sell in order for us to break even? In this case, 1,600 units of products that we need to sell so that we are break even if we sell at 68 ringgit. So this price per unit, we can actually adjust accordingly. It depends on how much profit that we would like to earn. And the next one is about the financial management. Just now, this one is actually if we wanted to start a business, what type of financial management that we need to identify. These are the three key components that we need to identify when we wanted to start a business. And the next one is, why is it important to know financial management, to understand about our business finances? Because it will help the company to plan and also to know where the funds from, the acquisition of funds. And then we also can make a decision to utilize and also to allocate the fund, and also making critical financial decision, especially during the emergency, and also to help improve the profitability of the company and increase the value of the firm, increase the overall value of the company. If the company have a profit, therefore it will increase the value of the company, and it will also provide the economic stability. So for the financial management, there are three main important contents that we need to understand. The first one is balance sheet, income statement, and the cash flow. So these are the three contents that we need to understand in the financial management. And these three things are in the financial statement. So when we said about what is your financial statement? Is your financial statement is good? How is your balance sheet? Is your balance sheet is balanced? Is the income statement good? Is it positive or is it negative? Means is it profit or is it losses? And the cash flow is to show money in and where it's spent to. So these are the three main types of financial statement: balance sheet, income statement, and cash flow. Regardless whether the company is a small company, big company, they need to have these three. Why is it important? Because if we have these three statements, it's easy for us to make decision, to do forecasting, and then to apply for the loan or to apply for financing. Because financial institutions, when we wanted to borrow fund from the financial institution, for example, bank, they will look at the financial health of the company for several years. And those are the statement that they will request: balance sheet, income statement, and cash flow. So here we will look at these three statements together and how they work together to give you the full picture of the company financial health. So first, we look at the balance sheet. So balance sheet, this is the balance sheet, example of the balance sheet. In the balance sheet, it has current asset. It has current asset. And then total asset, it has liabilities and equities. So the value of the asset, current asset and fixed asset. This is fixed asset, current asset. We add up together equals to total asset. Total asset should be balanced with the total liabilities and stockholders' equity. So the total assets minus the liabilities, we will get the equities. So this total stockholders' equity contents are the capital stocks and retained earnings. Okay. So first we look at the assets here. Asset, what does it mean by asset? Asset are anything that is valuable to the company own, including cash, furniture, inventory, patents, and is broken up into current asset and fixed asset. So current asset is like cash or cash equivalents, which is something that we can turn quickly into cash. And then we have liabilities here. The liabilities are debts. Debts means that we owe to other people. Yeah, debts that we owe to other people. Hutang lah di sini ya, hutang. That can be like credit card debt, mortgages, accrued expenses such as utilities, taxes, or wages owed to the employees. So like asset, liabilities normally broken up into current liabilities that the company owe within the next 12 months, and long-term debt. Di sini akan ada long-term debt normally ya. Long-term debt that the company owe more than 12 months. So the last category here is equity. Equity is the meaning value of the company after subtracting liabilities from asset. So total asset minus total liabilities will get the stockholders' equity. Right. So equity are like common stock, and common stock is like when we buy a company stock, the MB stock from Bursa Malaysia, and that is called the equity. Equity can also be in the form of retained earnings. This is retained earnings, which is the amount of income left over for the year business after paid out any dividends to the shareholders. So the retained earnings are from the leftover for the year business. Okay. And then the whole, this about the whole balance sheet. And dalam balance sheet, in the balance sheet, we have assets and we have liabilities and stockholders too. Stockholders equity, and the value for total asset should be equal with the total liabilities and stockholders equity. And so here, if we have to make sure that total asset balance at all the time with the liabilities and equity. Right. Then for example, for small businesses, like we just wanted to come out with a business. Small businesses normally prepare balance sheet for every 3 months, but big businesses, large companies, they will prepare the balance sheet every day. So how to prepare? It depends on how many assets are moving in and out from the businesses. If it is so active, then you have to update it daily or weekly. So that is about balance sheet. So balance sheet shows about assets, liabilities, and stockholders equity. So what can we really learn from the balance sheet? There are lots of things here. First, from the balance sheet, we can later calculate the current ratio of the company. Current ratio of the company will be current assets divided by current liabilities. Divided by current liabilities, the short-term liabilities that were only owed by less than 12 months. So current ratio is important because it tells us whether the company able to pay off their debt within a short period, within the next 12 months. So that is very useful because sometimes we need to know whether the company are able to come up with the emergency. Okay, so kalau tak cukup, then we have to borrow for a short term period. Next one, we look at the income statement. Right, this is the income statement. Income statement. In the income statement started with the net sales, and then minus all the expenses, minus taxes, we'll get the net income. Net income is also known as net profit, net income. It can be used interchangeably. And the net income normally after we pay the dividend to the stockholders. If we look at this income statement, the net profit that we calculate here is also known as the bottom line. And the net profit sometimes is negative. The value here sometimes is negative. In this case, is positive. If it is negative, what does it show? It shows that the company actually incurred losses. If it is positive, then the company has a profit for that particular year. Sometimes the company generate lots of sales. They generate lots of sales, but the net income is negative. Why? Because the company spent a lot of money on the expenses. It can be on the cost of goods sold. It can be on the operating expenses, or they might have to pay high interest.
Tapi tak ada dalam graph pun kan? Tak ada graph.
Those are the things that we need to identify. We need to carefully read whether the company incurred losses due to the high expenditure. What happened there? All right. So income statement also shows us how much money that the business spent and how much it has earned within a specific period. That is how we calculate the net income. Yeah. So if we look here, cost of sale or cost of goods sold is how much money it costs to make and distribute the product or the service. That is under cost of sales or cost of goods sold. And this does not include things like cost of hired bookkeeper or cost of rent. Those costs of rent will be under operating costs. Yeah, under operating costs di sini. Okay. All the wages semua under selling, general and admin expenses. So how to get the operating income? Operating income, the gross profit minus the selling, general and administrative expenses. Then we get the operating income. Interest expense are the interest that the company has to pay because they borrow money, short term or long term. They have to pay interest, and it will incur under interest expense. Okay, operating income or loss. Di sini operating income. Operating income or loss here is from the gross profit. Just now already mentioned gross profit minus selling, general and administrative expenses. Sometimes operating income can be negative operating income. It's not necessarily be positive here. Sometimes too much, the expenses is too high, operating income's already negative. All right. So we need to understand why we need to come up with the income statement. As I mentioned just now, when we wanted to make decisions by whether we need to have additional fund, we need to go to the financial institutions to borrow money, they will look at our income statement, balance sheet, and also the cash flow. So in net income or net profit is actually how much money that we walk away after we subtracting all the expenses, taxes, and dividend to the shareholders. So net income normally, if the company has negative net income for several years, for at least 3 consecutive years, it's difficult for the company to get the business loan. So that's why income statement is important as evidence to the financial or to the creditors that the company is in a good positive net income, because it shows the income, balance sheet, cash flow shows the financial health of the company. And next one is the cash flow. This is Apple, and one of it is Apple. Yeah, ini give you the summary of Apple's financial statement. This is Apple financial statement. This is the balance sheet, Apple balance sheet. It has current asset. This is non-current asset. And then has current liabilities. Non-current liabilities. Non-current liabilities is long-term liabilities. And then it has the shareholders' equity. And the total for Apple di sini, the total assets is the same with total liabilities and shareholders' equity. All right, what is cash flow? The third one is the cash flow. As I mentioned just now, in the financial statement, we have balance sheet, income statement, and the cash flow. So for the cash flow, what does it shows in the statement of the cash flow? This is one statement of the cash flow, one of the last financial statement. And the cash flow statement shows how much cash has entered and how much cash has left the business over a particular period of time. It can be 6 months, it can be quarterly, it can be yearly. Okay, in this case, 6 months ended. So here, cash flow shows how much cash has entered and left the business for the 6 months period. So what is the different cash flow and income statement just now? Cash flow shows cash entered and left the businesses. This is not, cash flow is not the same like income statement. It's not the same like income statement. Why? Because income statement just now shows the net profit or net income of the company. So let's say under income statement, let's say in the income statement says that we make 100,000 in March, but the cash flow statement, and this is the cash flow statement, last kali ada cash flow statement. In the cash flow statement, the cash flow statement only shows that we make 5,000 in cash. It does not balance between 5,000 and 10,000. What is actually going on here? So first, it might be because we send 2 invoices to the clients of 5,000 each. So it depends on what system of accounting that we use. Sometimes if we use accrual, so we might record the 10,000 as a revenue in March, even though the payment has not get paid yet. Then one client pays, another client is late, but income statement will say that 10,000, but cash flow is only 5,000 because only 5,000 cash coming in. Another 5,000 is still under late payment. So it is important, very super important to know what the cash situation of the business is. If we don't have cash, to pay bills, even though you have accounts receivable money on the way to you, because cash is important for us to pay, for us to do the daily operation. So it's all will be transparent in the statement of the cash flow. Okay. So here, under the cash flow statement, this is the consolidated statement of the cash flow of Apple Incorporation. It has cash, first it has cash, and then operating activities like net income, and then the total cash generated by operating activities. And then we have investing activities. So in the cash statement, in the cash flow statement, first we have cash beginning of the balance. And then we have operating activities that use the cash. And then we have investing activities. A third one is we have financing activities. Okay. And then finally, we calculate how much is the cash in hands. The balance cash in hands by ending balances will appear in cash equivalents, ending balances here. 40,000, in this case is 40 billion, yeah? 40 billion. So what is the importance of cash flow? Cash flow statement. Cash flow statement shows how much money comes into the business and how much and where the money is spent to. So sometimes we would like to generate a positive cash flow. This any value, we wanted to have a positive cash flow. There are several strategies that we can use to create a positive cash flow. For example, increase the number of items sold, like revenue, increase the price of the items, reduce expenses, change the timing of expenses, obtain sources of cash other than sales, such as line of credit. And there are several others strategies that we can use to create a positive cash flow. So those are the three statements that we should have when we construct the financial statement. We need to have balance sheet, income statement, and the cash flow. All right. The management needs. What does it mean by management need and what are they? The management needs is actually what the business owner need to know in business finance. For example, in business finance, the company, the owner of small businesses, let's say small businesses, if we wanted to open a small business, we need to know about the business accounting. What is it? We need to know where to record, how to record the business, money in and out, how to organize it, and understand the financial information. The financial information here is like the business transaction, the taxes, and also the projection. All these balance sheet, income statement, and cash flow, once we construct it for that particular year, we can also do the forecasting. We do the forecasting. Why we need to do the forecasting? Because we need to know in the next 3 years or 5 years, what is the financial health of the company. So the management needs here, they needs to understand the financial information in order for them to do the projections, in order for them to pay tax, in order for them to run the business transaction or daily businesses. The business finance is important also because it will show whether the company has a profit or losses. Yeah, for example, just now in the income statement show the net income. So net income can be positive net income or can be negative net income. So with this business finance, the company can make a business decisions if they wanted to apply a business loan, if they want to pay tax. So it is important for the business owner, to manage their business finances, because business finances will tell the audience, will tell the market how the financial conditions of the company. As I said just now, under business finances, it shows whether the company is making profit or not, and how is the cash flow, what is the current value of the company asset and liabilities, and which part of the business they are actually making money. So those can be known from looking at the balance sheet, income statement, and the cash flow. And these business finances can be, we can identify by looking at these 5 areas. So we can manage the business finances by looking at these 5 areas. So in other words, in order to be a good owner of the companies, in order to know whether the company has a good health of finances or not, we need to understand these 5 areas. First, managing money, bookkeeping, financial statement, making business decisions, and prepping for taxes. Managing money is like managing bank accounts, managing credit cards, managing loans. Bookkeeping, meaning recording and categorizing. Yeah, bookkeeping means recording and categorizing the debit or credit, and then from there we come up with the financial statement. And the fourth one is making business decisions. When we read all the financial statement, we read from the financial reports, we are able to make changes to the businesses. How? Let's say if the financial statement says that the company has a positive profit, meaning that the company is in a good health, is in good position. So the company might think that they would like to increase the product or expand their businesses. Also, if the net profit is negative, the company can identify where to get the loan in order to finance the losses. And the last one is prepping for taxes, means preparing all the financial statement to pay for the yearly tax. So the first one, all right, so now under management needs, I repeat again, this is if you are the business owner, how do you manage your finances? What are the key areas that you need to understand and manage properly by looking at these 5 areas? And the first one is managing money. We always keep businesses and we need to perform the personal finances separately. This is personal, this is personal finances. So as a business owner, the business account and the personal account need to have a separate account. We cannot mix it together. How to keep the finances separately? We open up separate business checking account. current account, one for business, and one for the personal, and only use it for business transaction. Never use our personal credit for business transaction. We have to apply separately. So here, rule number 1, always keep business and personal finances separate. Because when business and personal finances mix together, this will make bookkeeping and tax very difficult later. And also, when we review the account in a month or a year, it's difficult for us to put it together because we tend to forget what the receipt is for. Is the receipt is for the lunch with a client or a friend? We might jumble the credit card statement between business and the personal. So by mixing both together, it won't be helpful. So meaning here, more importantly, mixing business with personal could hurt the business legally, right? So that is the main rule. Always keep business and personal finance separate. A second one, in terms of the accounting, which is the bookkeeping. Bookkeeping is important because it will record every financial transaction and categorize it. For example, what the purchase is about, when we purchase it, what is the amount of the cost, the date of the purchase, and the category, whether it is under revenue or is it fall under expense. So we can record and categorize every financial transaction. If we do this, it will help us in at the later stage when we wanted to prepare the financial statement and we wanted to pay for the tax. So here, bookkeeping transaction is important to be updated. Big corporations normally daily, but for small company, normally every 3 months. Or it depends on your activity. If you are active, if the company is active, then you might do it every weekly. It depends on how active is the transaction of your company. And then a financial statement. Just now in the financial statement, the business owner need to understand their business transaction, their financial statement, need to understand the balance sheet. What are the asset they have? Is it current asset or is it long-term asset? Is it fixed asset? And then they need to know their liabilities, short-term liabilities or long-term liabilities, and the amount of equity that they have. So basically here, balance sheet, income statement, and cash flow statement, like the one that I already mentioned here, is important. Part of the management needs to understand the business finance. Where, I repeat again here, under income statement, it shows the profit or loss of the company. It shows from the revenue minus all the expenses and come out with the profit or loss of the company. And then the third one, cash flow statement, it shows how much cash that the company have in hand at that particular period. So under business finances, these 5 key business finances need to understand by the business owner so that they can keep track of what their business financial position or financial health. And last one, the second last one is making business decision. After the company identify whether the company has a profit and how much is the cash flow for that particular period, they can actually make a decision. Making decision, for example, if it is losses, they need to understand where to get the fund to finance the losses. macam they might need to top up the capital. All right, so here, so making decision also is important so that the company can really making real business decision based on the balance sheet, income statement, and the cash flow. So the business financial information are actually what we are seeing from the current balance sheet, income statement, and cash flow. And the final one, prepping for tax. Prepping for tax means that the company have to prepare for tax for that particular year by digging up last year tax return, have trial balance for the year, and get all summary of all income tax estimated payment for the last year so that the company can pay tax for that particular period. So it's all in order to pay for the tax, the company needs to have the financial statement. They needs to have up-to-date bookkeeping so that they can prepare for the tax for end of the year. And finally is raising capital for businesses. When you wanted to start the business, where to get the money from? Started business can cost 100,000, a few millions, a few thousand. It depends how big is the company that you wanted to set up. So in order to raise the capital, there are several channels that we can look into. For example, the first one is personal loan. The personal loan, normally this would not be the first thing that comes to mind when we wanted to have a business funding, but it can be one of the easiest way to have if the amount of capital is small, and also if we wanted to find the fund quickly. This is a personal loan is normally suitable for micro enterprises that don't need a lot of capital, such as food truck businesses, home bake bakery, online businesses. They might use the personal loan to raise the capital. Or for the business loan itself, business loan, when the company has several years of financial statement, they might eligible to apply for the business loan. And the business loan are harder to qualify compared to the personal loan, where the financial institution normally need a minimum number of years of the company in operation. And also the company might also need to put up collateral to be eligible for higher amounts of funding. So sometimes need minimum number of years of operations, collateral needed for higher amount of funding, which is a bit difficult for a new beginners, a new company to apply for business loan, because the funds received will come with some restriction. For example, the fund that we receive are not able to use to purchase shares or real estate investment, for example. Yeah. All right. So the third one is grants and scheme. The grants and scheme. The grant and scheme are normally from the government or corporate schemes. For example, the SME Corporation Malaysia, Magic. Magic is normally for the tech company, technology company. From MDAC, these are the government grants that suitable for certain type of businesses. All right, the government grants financing, or mentorship and networking opportunities is only available for certain period and for certain type of businesses. And some of the financing scheme granted by the government or corporate schemes has set of eligibility requirements. For example, those looking to increase their digital capabilities or demographic. For example, if you are female entrepreneur or Bumiputra applicants, there are several grants available. So those are a very specific grants. And sometimes some grants can be very competitive. It requires several rounds of evaluations before your application is accepted. But there are a few grants available by Magic lah yang paling banyak sekali so far, and also SME. Other financial institutions also offer a grant for specific types of company. And then we look at crowdfunding. Crowdfunding is just is a new raising capital. The new company can raise money through a large pool of individual investors, and it's called crowdfunding. So crowdfunding is raising money through a large pool of individual investors, and there are few types of crowdfunding available. The first one is reward-based crowdfunding. So we'll see that this model is normally in international sites like Kickstarter or Indiegogo, where users pledge money to other individuals or businesses in exchange for tiers of non-monetary reward. Then donation-based crowdfunding. Donation-based crowdfunding, if you go to a website like GoFundMe, GoFundMe allows users to support charitable causes or local entrepreneurs without expecting anything in return. Reward crowdfunding just now like Kickstarter. These are all the Malaysian-based. Kickstarter or Indiegogo. You go to their website and then you can read on the requirements. Equity crowdfundings. What is equity crowdfundings? When individuals invest in companies in exchange for a shares or ownership or profit. So equity crowdfunding site in Malaysia, for example, equity crowdfunding in Malaysia, for example, LEET, Let Capital, Crowdo. So these are the equity crowdfunding base. Pitch In firm very famous. Pitch In, IN. Pitch In. So raising funds through crowdfunding is easier compared to through business loan or personal loan. And some platform, they will not disburse any fund if the business does not reach any target funding. So here, since last 5 years, crowdfunding is very famous in Malaysia for the starter, for the business starter. The next one is P2P lending. What does it mean by P2P lending? Peer-to-peer lending. Peer-to-peer lending is debt-based crowdfunding. Debt-based crowdfunding is when the investors pool money to lend to businesses. And P2P loans can be an alternate financing option if the businesses do not qualify for the bank loan. And lastly, venture capital. Venture capital, when firms or individuals who fund businesses that show high growth potential. And the capital is pooled from other individual or corporations and normally is given by the investors, a high net worth individuals. and they would like to invest their own money in early stage companies, and that is called venture capital. All right. So I think that's all for my talk about financial management, management need, and raising capital.
Thank you so much, Dr. Balkis. That was a very compact talk you gave us and very interesting as well. Banyak yang I baru belajar hari ni.
Thank you, thank you.
To all the participants, ada question tak nak tanya dekat Dr. Balkis? Please take the opportunity. Dr. Balkis, kalau when it comes to getting making up, kadang-kadang kita nampak these companies they give out like this quarterly reports kan. So is that from the financial statement of the company? Or
Yes, everything about because every company they have to come out a quarterly financial statement. So that's why we can see a quarterly financial statement, and of course every financial statement has to come from every single receipts. Yeah, it starts from
see.
bookkeeping. We actually collect all the receipts and then we put it in the bookkeeping. From there we come up with the income statement and the balance sheet and then cash flow. Without the bookkeeping, it's very impossible for us to come up with a good financial with a good income statement, balance sheet and cash flow. That's why bookkeeping is important. Every single receipt is important. Yang macam individual personal finance juga, when we wanted to know how much is our expenses, we have to keep the receipts. Same goes to the businesses. Cuma whether the businesses is small business or large business, so it depends on if they are large. Normally they have to update the bookkeeping every day. That's why they have that's why they have own department. Every dalam finance department they have a sub department only for accounts receivable and only for accounts payable, because they receive lots of activities, transactions. But for small businesses like individuals, like us, if you want to come up with the businesses, we have to make sure that every receipt, daily receipts, we keep it at one place, and make sure that we separate between personal and also business accounts.
I see. Okay, thank you, Doktor. Ada satu soalan daripada Aizat ni. Adakah
Yes, Aizat.
berbaloi jika personal investor make personal loan and invest on certain potential company?
Alright.
Dekat
Personal loan is high interest, very high interest. Then if you wanted to compare between interest of personal loan versus the new company potential profit, if you are willing to take that high risk, then go. But normally when we make an investment, we don't borrow. We make an investment from our saving, unless we are a businesses. Kalau individual, even if you wanted to make any investment, buy stocks or any kind of businesses, make the investment from the saving, not from borrowing. Yeah, because what happened in 1997, masa tu Malaysian financial crisis, we hear that numbers of people commit suicide. Because when they make an investment, from borrowing. So we doesn't want it to happen to our generation. So might as well you avoid it.
ada satu
Hopefully
lagi
that answer.
soalan. Ada satu lagi soalan ni. Apa cadangan doktor terhadap pengurusan keuangan untuk peniaga di pasar malam?
Which is very good. Peniaga pasar malam also have to make sure that they separate the expenses and also cash between business and personal. So if they have personal finance, they do the personal financing, it will be very good so that they know where the money come from and where it's spent to. Kalau tidak, dia semua jumble up together. which is difficult for them to have a good business finances.
Ada permintaan ni daripada Nahayati, boleh explain balik tak formula untuk kira break even point in detail?
Break even. Boleh. Break even. Oh, I kena share screen ya. Share content. I share screen. Okay, dah nampak. Break even equals to the cost, the fixed cost di sini ya. So break even equals to the fixed cost. Let's say fixed cost is just now is 80,000. That is fixed cost. Fixed cost divided by variable cost. Let's say variable cost just now is 18 ringgit. Time price per unit is 68. Let's say kita buat handbag lah. Ya, kita buat handbag and then fixed cost to setting up the company selling handbag is 80,000. And then variable costs are the costs to run the to actually come up with the product that is under variable cost. So the variable cost, for example, 18 ringgit, and the selling price, this is selling price. Our price per unit is 68 ringgit. So this is fixed cost, 18 is variable cost. So we'll have to sell 1,600 units of handbags. Ni 80,000 ya, 80, 1, 2, 3, 80,000. So here, what does it mean? It means that for us to be able to cover all the fixed costs, we have to sell 1,600 unit of handbags. Tapi if we wanted to have profit, how many units we have to sell? We have to sell more than 1,600 units. If we sell less than 1,600, we'll incur losses. Yeah, we incur losses. So we have to sell minimum 1,600 unit. Kalau jual 2,000 unit, it means that we have we get more than break even. We have profit for that. Okay, I hope that answer the question.
Dr. Balkis ni banyak peminat. Ada satu lagi last question maybe.
Okay.
Kalau Dr. Balkis, for small business startup, is it invest on people or system in accounting?
System for startup. Okay, for startup is cheaper to buy a ready-made accounting software. Yeah, accounting software for bookkeeping, for daily transactions, for income statement. They already have the in the market. There are companies that sell the accounting software, so it's cheaper to buy that one rather than you hire people for a startup. It costs maybe around 1,000 daripada kita hire seorang, which we have to pay salary for about 1,200, 1,400. It's cheaper to buy the software. We understand the system. We understand our company first. After a few months, after a few years, when it's stable, then only you hire people to do it for you. All right.
Thank you so much, Dr. Balkis. That was
You're
very
welcome.
interesting. Hope that we will keep in touch. Maybe ada lagi Dr. Balkis boleh share dengan kami in the future.
Boleh. No problem.
Okay, so thank you so
Yes.
much.
You're welcome. So I stop
so-
here. I stop here. Then we go to the third presenter.
Yeah.
All right.
Thank
Thank you,
so
Faz.
much. Okay, so our third speaker right now is Associate Professor Dr. Rosita Haji